Good afternoon, everybody. Uneducated Economist here. So I've been listening to a lot of people talking about negative interest rates and trying to really wrap my head around it. There's no economic model out there that discusses negative interest rates. There's no history to go back on to say this is what you can expect from negative interest rates. The one thing that I do see is that both bonds and gold are rallying at the same time. And since I read that Seeking Alpha article talking about tier one assets and gold being one of them, and that's one of the reasons why you're seeing gold rally during the same time that bonds are rallying, is because banks are looking for a place to park money that isn't going to deteriorate. And since tier one assets is now, or since gold is now a tier one asset, gold is like part of their portfolio. Now, I tried to go find more information on this, and it's really not much talked about. So I'm really curious on how much gold is actually being purchased by banks for that purpose of being held as an asset to meet the Federal Reserve requirements. Now, I know central banks around the world are buying a lot of gold, and that would make sense considering that the dollar is this dominance of the world currency is getting stronger, and it's making it more difficult for people to do trade around the world, and especially trying to buy American products. So people are looking, when I say people, I mean central banks, economies around the world are looking for a place to try and do transactions that's outside of the US dollar, and really there's no other option outside of gold. There's nothing else. And cryptocurrency is I believe, a viable concept that will work, but not at this point. The only thing that's really an option out there is gold, and that's probably one of the reasons why you're seeing so many of these central banks buying it, is because they see that the world trade is going to be needing a currency that they can hold that doesn't deteriorate. We got inflation that's going to kill the purchasing power, and at the same time we got negative rates, which means that you can't get anything out of your savings from buying treasuries. It's a very unique situation. Now, if you think about it as a bank, and you got these two assets that you can hold, you got your treasuries that may soon carry a negative yield to them, but as the interest rates drop, you can sell them for a profit. But you got this treasury that normally it says, hey, if interest rates rise, that doesn't matter because you'd be able to hold on to it till it matured and you get the face value back from it. So it has a no loss to it. But now with the negative rate, when you buy it, it's guaranteed to have a loss unless interest rates drop. And when you buy gold, it's kind of like a guaranteed loss. Either you're going to pay a premium or storage or something like that. Now it comes down to the bank's decision on whether or not the treasury that has a guaranteed loss to it but does have a face value that's going to pay you back is worth more as an asset to have than gold, which is going to carry both the premium and the storage and everything else that comes with the cost of gold. And which one do you think is going to happen? Are interest rates going to drop and cause the bond prices to go up more than the gold prices are as far as spot price goes? It's very interesting times that are coming up. So anyway, Uneducated Economist, you guys let me know. I'll give you guys a shot of the river. Oops, put my finger right in the screen. Sorry about that, guys. Uneducated Economist. You guys let me know.